How's it going? Bill Lethman here for Money Evolution. In today's video, I'm going to be taking a deep dive to help you to create your retirement withdrawal and tax strategy. Now, if you've been watching me on the channel for a while, you know I talk a lot about taxes, and you probably know I also talk a lot about retirement withdrawal strategies as well. Well, in today's video, I'm going to be combining them together. Why am I doing this? Well, your retirement tax strategy is very much connected with your retirement withdrawal strategy, and the two of them are really interconnected with one another. So if you need more money, for example, to take out of your portfolio, in most cases that's going to increase your taxes. So in today's video, I'm going to be taking a deep dive to help you to really understand this. So let's talk about some of our goals here for today. And this is going to be a little bit longer video, and I think you're going to really get a lot of benefit out of it though if you watch it all the way to the end. There's a lot of different things that we're going to get into today. But our goal, number one, should always be, if we're talking about retirement, is to have enough money for you to be able to do the things that you want. So that's going to be a really important piece of this, that you have enough cash flow coming out of the portfolio and maybe from some of your predictable income sources like Social Security, and if you have a pension or anything else coming in, that's going to be a big part of it. But also, what are those retirement withdrawals? And if those are coming from a traditional retirement account, there's going to be ordinary taxes that are going to have to be paid on those withdrawals. If you have money that's in a non-retirement account, there may be capital gains, there may be dividend income or interest income. I'm going to get into how all of those different components are taxed and where some of these key tax thresholds are going to be, and some of the things that you want to watch out for as you're putting together this tax and withdrawal strategy. The goal here is to really kind of map out and see what our tax situation is doing through different phases of our retirement. And the goal is to kind of smooth out those taxes. What we want to avoid is we want to avoid higher future tax rates that are going to be exorbitantly high, and it pushes us up into a higher tax bracket. And sometimes for a lot of people, if you're not putting together a plan like this, those taxes can really get away from you, because you might say, hey, I retired, I'm in a very low income tax bracket right now, and you don't realize some of the other gotchas that are coming up down the road, like required minimum distributions and some of the IRMAA penalties that may kick in for Medicare if you're not careful. So we're going to be getting into that as well, but keeping the long-term tax rates lower and smoothed out throughout your retirement. That's going to be our primary goal here. If you're retiring early, before Medicare kicks in at 65, we're going to talk a little bit about that ACA subsidy. If you want a lot more detail about that, I made another video where I took a really deep dive on qualifying for an ACA subsidy, but that's something that can really save a lot of money. It's not necessarily a tax, but those ACA premium costs can really dramatically go down if you can qualify for a subsidy. Not everybody's going to be able to qualify for a subsidy. We're going to talk about what those parameters are to be able to qualify, and if you're in that situation where you could potentially get that ACA subsidy and it's not jeopardizing some long-term taxes down the road, we'll get into all of that, but that's one of the things we're going to be talking about. And then we're going to talk about IRMAA. That's another one of those extra taxes. It's not really a tax, but it's something that is definitely linked to your income. So if you have modified adjusted gross income that goes over certain amounts, your Medicare premiums can go up, and they can even go up a lot, sometimes 2 or even over 3 times as much for your Medicare costs if you exceed certain thresholds. So we'll be getting into all of that here as well. Now, as we look at your retirement, there's going to be 4 distinct phases that you're going to go through as you move through retirement. And I'm going to be getting into each one of these phases and talking about the strategies and the action items and some of the things that you should be thinking about in each one of these phases. Now, some of you may still be working, and you still may be a couple years away from retirement, or maybe you're even 5 or even 10 years away from retirement. So I think the earlier that you start this process and start to think ahead as to what that retirement may look like is going to give you a really big advantage to be able to make some of these tax moves that could set you up in the future for a better tax situation and maybe even a better retirement withdrawal situation. So we're going to be talking about that phase when you're still working and what are some of those things you could be doing. Then likely you're going to go through an early retirement phase. That's generally how I define it, as it's before your Social Security kicks in. Most people probably watching this video, your full retirement age for Social Security is going to be age 67, and that's when you can get fully unreduced Social Security benefits. I know some people might wait till age 70 to really maximize the benefit. Other people may take those Social Security benefits a little bit earlier. I'm not going to get into the Social Security planning strategies that go into that here in today's today's video, but I've made other videos where I do take a deep dive on that. But that early retirement phase is usually going to be defined primarily by having some larger retirement gaps, because likely you're not going to have some of those predictable income sources coming in that early phase of retirement. You also may have some higher expenses in the early part of your retirement. That may be because you want to do some travel. I know that's something a lot of our clients are wanting to do. They want to retire and they have a bucket list of things that they want to do in their retirement. So they've made that list and they want to start knocking some of those things out. So those extra travel costs, for example, may be much higher in the early part of retirement. You might have heard people, maybe even me, talk about the go-go years, the slow-go years, and the no-go years. So those go-go years are when you really want to maximize the stuff that you're doing in retirement, and that oftentimes takes a little bit of extra money to do that. And again, one of the other things about that early retirement is because those expenses are higher, you're going to have larger gaps. Another reason for that is that if you're retiring before Medicare kicks in, you may have to go out into the exchanges and get that health care. That's going to be substantially higher than what those Medicare premiums are going to be. Again, we're going to talk a little bit about an ACA subsidy and where some of those thresholds are. Again, I've made a different video that I get into all of those details. At full retirement age, again, that's going to be at age 67 for most people. That's generally where some of those predictable income sources are already kind of set. And now the gaps going forward may be a lot more predictable. So that's going to change things up a little bit there. And it's going to usually mean that it's going to be a reduction to the amount of retirement withdrawals that you have to take from those portfolio assets. So that's going to be another phase. And then the last phase is going to be where we don't have a lot of control over, at least at that age, at age 75 or age 73, is your required minimum distributions. So the latest round of legislation said that if you were born in 1960 or later, your RMD age is age 75, and if you were born before 1960, your RMD age is going to be age 73. Essentially, that's where the IRS says you've gone long enough without paying any taxes on those traditional retirement dollars, those 401ks and IRA accounts that have not been taxed yet, and whether you want the money or need the money or not, you're going to have to be forced to start taking some mandatory distributions. So we're going to talk a little bit about that, where those distributions can potentially be a problem for you later on, meaning that you're going to be pushed up into a higher tax bracket, and again, maybe even higher income tax bracket. So those are the four phases that you're going to go through, and each one of those phases is going to have a slightly different strategy and a list of things that you should be thinking about and doing to really maximize this retirement tax and withdrawal strategy. So a few things that we need to know as we're building out this plan. Number one is we need to know how much money you need, and that's where we start to talk about this map. And if you watch my other videos, you know I'm big on maps, I'm big on timelines, and really kind of sketching out what are all of those different things that are happening over time. When does Social Security kick in? When does my Medicare kick in? Where are the expenses? If I want to do some big travel early on, you know, those gaps are again going to be a little bit bigger. So how much do you need each year? We're going to keep things relatively simple and just assume that you need the same amount throughout retirement, but in reality, that's almost never the case. There's always things that are going to be more spending in some years and less spending in other years. Even if you think about travel, you might do some bigger travel one year, and maybe the next year you don't do as much travel. You got some big trips, and then you've got some small things that are on your list. You may have car purchases that are in there. Maybe you're buying a new car every 5 to 8 years, and that's going to spike up those expenses in those years. So those are things that you want to be planning ahead for and understanding and knowing what are those future expenses and what is that doing to your gap. And again, that gap is going to be the thing that's going to determine how much money you need to take out of your retirement accounts. So I kind of skipped ahead there. What are the gaps? You know, so what are those gaps every year? How much do you need to take out of the portfolio? And then finally, where is your money? We were going to talk a little bit about the three primary tax buckets, and essentially your money could be in one of three spots as we're relating it to tax purposes. You could have money in non-retirement accounts. That might be bank accounts, savings, money markets, CDs, things like that, liquid money that's not in an IRA account, not in a Roth IRA account, not in a 401k. You may have some brokerage assets. Maybe you've got some stocks or some ETFs or mutual funds and things like that, and that's going to be another part of that non-retirement bucket. We're going to want to understand that, how those different buckets break down, and what are the cost bases of those non-retirement account assets? Do you have big gains in there? That's going to be something we're going to want to think about as you're taking withdrawals, because if you take a withdrawal and you need to sell a stock or a mutual fund or an ETF that has a gain, that's going to be taxed, of course, and so we're going to want to understand that. The second bucket is going to be your traditional money. That's going to be 401ks or IRA accounts. That's money that generally was contributed on a pre-tax basis, so you got to deduct that off of your income when the money went in. The money is going to grow tax deferred, so you're not paying any taxes on that until you pull that money out. But once you begin taking those withdrawals, that's all going to be taxed as ordinary income. And we're going to get into that a little bit more, but the ordinary income is going to be at your highest marginal tax rate. So that's important to recognize that. The last bucket is going to be your Roth bucket, and that's where money generally was contributed on a after-tax basis, so you paid taxes when that money went into the Roth account, and then as that money comes out, as long as it's a qualified distribution, it'll be tax-free for you in retirement. And there's going to be a specific ordering of which account to take money from first, which money to take money from second and third, and how do you kind of balance those three buckets out, and when do you take those withdrawals, and what is that doing to your tax situation? Okay, so let's see what this looks like as we start to map some of this stuff out. What I drew up here on the screen is kind of a replica, a little bit, my crude drawing of what our financial planning software does in our cash flow reporting. Basically what we're doing is we're kind of mapping out the income and the expenses over time, all of those withdrawals being taken into consideration, taxes are being calculated on a regular basis. So it's a pretty advanced piece of software here. What I did is just kind of drew this out to help you visualize what that retirement looks like and where some of these gaps are. So if you're still working, likely you're going to have more money coming in than is going out. You're going to have maybe some automatic savings that are going into your 401k plan, or maybe there's money that's being built up inside your non-retirement accounts there. But that gap, for purposes of this, is going to be a positive gap, hopefully. Hopefully you're not running into negative cash flow while you're still working here. But what we want to know while we're still working is, where is that excess money going? And it's probably going into one of these three buckets here. It's either going into non-retirement, traditional, or to Roth. And I'm going to get into a little bit more detail of where we should be putting that money and how we should be thinking about that. But that's going to be basically that phase when we're still working and what we should be thinking about. Again, what we're going to see here typically is that our gaps in the early part of retirement are going to be much greater here, and we can see that as I kind of drew that out. And that's pretty much how most of our financial planning clients' plan looks, is that in that early part of retirement, those gaps are definitely going to be a lot bigger there. And again, that's going to be before Medicare kicks in. I showed a little bit of a reduction to the expenses here where the Medicare costs kick in, and maybe you don't have to pay as much for those Affordable Care Act subsidies. Your travel budget and some of those extra things may be a little bit bigger in that. And then as you start to get Social Security, for example, that's going to maybe shrink that gap a little bit. I kind of drew a little bit of an inflection point here and here, because I assume that maybe you and your spouse, if you're married, are not exactly the same age. So you may want to have this mapped out where your Social Security kicks in here, and maybe that's 2030, but your spouse's Social Security benefits don't kick in if they're waiting until full retirement age until 2032. That might be 2 years later. And then generally we're going to see that level of income really kind of level out there, and it's probably not going to go up a lot other than the withdrawals that you're taking from those retirement accounts. But basically, all of this in here is basically going to tell us what that amount of withdrawal is going to be from your portfolios as you move through these different phases. And that's very important. It's probably the most important thing to understand. A lot of people can do this with a spreadsheet. I've seen some really advanced tools out there that can really kind of map this out, spreadsheets that have been done by clients. Again, we do that as a part of our financial planning process. And by the way, if you want to learn a little bit more about that and how we can help you do this on a much more sophisticated level, we'll put some links down in the description below for that. Okay, so what we're really going to try to understand here as we get into some of this planning here is we really want to understand what's happening to our three primary tax buckets, those assets that we've saved up in our portfolio for retirement. And there's going to be a few factors that are going to go into that. Number one is we're going to know or want to know what money is going into those buckets while we're working. So if we're still working, we're likely going to be contributing money to one or two or maybe even all three of those buckets. So we're going to want to know how much money is going in. Number two is we're going to want to know what is the growth of those buckets over time. And we're going to have to make some type of an assumption as to what that growth is going to be, so we can not only know what that value is today, but based on the contributions you're making and the growth, how is that moving over time? And then third, we're going to want to know, as you go into retirement, what's coming out of those accounts, because in retirement, you're likely going to be taking money from those portfolio assets, and that's going to be reducing the amount of money that you have in each one of those buckets. And then we're going to want to kind of map out over time what the value is in each one of those buckets. And in particular, we really want to know what the value is of this bucket right here, the traditional bucket. And is that going to be a problem for us later on? Because that's the bucket where every dollar that comes out is going to be taxed at our ordinary income tax rate. And if it's left unchecked, something that we see actually quite often with a lot of our planning clients is we see something like this. After we hit that RMD age, it's either going to be 73 or 75, depending on what year you were born, you may see the amount of your income going up. It's not because you got some magical source of income, but it's because the IRS is now mandating that you take minimum distributions from those retirement accounts, and you may see that line of income actually exceeding the amount of your expenses. And that could be a problem. That could be a problem for a number of reasons. Depending on how much that line is going up, it could mean that you're going to be paying a higher tax percentage than you could have paid had you kind of planned some of this stuff out and maybe done some Roth conversions or taken some withdrawals a little bit differently in those early stages. You could have maybe reduced or almost altogether maybe eliminated some of those higher taxes down the road there. So those are some of the things we want to talk about as we start to map this out. So generally, as you start to take withdrawals in retirement, there's going to be an order that's going to make sense. And for most people, it's going to be exactly the order that we have here. For most people, the order of withdrawals is going to be to take money from those non-retirement accounts first, and then taking money from traditional retirement accounts, and then last, you're going to take money from Roth. And usually the Roth accounts are really only going to be drawn upon if it's doing one of two things. One is going to be that it's keeping you from going up into a higher tax bracket. So if maybe taking extra money out of your traditional IRA account would push you up into a higher bracket, you may want to consider taking a Roth distribution to avoid that higher tax. One thing that we talk a lot about to our clients is that sometimes the tax brackets go up a little bit. Sometimes the tax brackets go up a lot. What do I mean by that? Well, the tax brackets go from 10% to 12%, and then they go from 12% all the way up to 22%. So if you're trying to hover on that 12% tax bracket, and we can keep it in that 12% bracket over time, then maybe it doesn't make sense to take more money that's going to be taxed now at a 22%. That's a lot of increase. That's almost a double of increase to the amount of tax. Then you go from 22% to 24%. Not a big deal, maybe. It's a 2% increase. But then it goes from 24% all the way up to 32%. So it goes up almost by another 10 percentage points, going from 24 to 32. So that's why it's so important to know where we are in the bracket. And we're going to get into it in a little bit too, but there's also a few gotchas along the way too, that higher levels of income could also mean a loss of a deduction. It could also mean a higher IRMAA cost and these other things that could be triggered from those taxes, not just the taxes themselves, but some of these, what we sometimes call stealth taxes that can kick in here as well. Okay, so now let's talk about the tax strategy that you can implement while you're still working. And there's going to be 5 different things that I'm going to get into here that I think can really make a big difference in your long-term retirement tax and withdrawal strategy here. And the first one of those things is going to be where you contribute your money. So assuming you're still saving money on a regular basis, you have an option to put it into one of these 3 buckets, the non-retirement, the traditional, or the Roth. And I know there's a lot of discussion out there. I had a client a couple of weeks ago that said they wish they had put more money into Roth accounts while they were working. In fact, I made a video after that meeting, and I talked about why I think for most people, the best option is to put that money into the traditional account. And here's why. So let's take a hypothetical example here, and let's just say you're at a $350,000 level of income. So at that amount of income, you're going to be pretty well into the 24% tax bracket. So if you make a pre-tax contribution to your 401k or 403b or whatever that may be, that's going to come right off of the top level of income, and you're going to save that 24% off of your income tax while you're working. Now in retirement, you're going to have to take that money back out, or you're going to probably need that money at some point for your retirement cash flow gaps like we were talking about there. So let's take a relatively extreme example. Let's say you need $200,000 a year in your retirement, and assuming that makes sense for your long-term cash flow plan, that $200,000 is going to come out of a traditional retirement account, and it's not even all going to be taxed because coming right off of the top of that is going to be your standard deduction or your itemized deduction if you're itemizing. So that means that $200,000 is not going to be the amount you're going to pay taxes on. It's going to be, I think, more like $168,000 that's going to be subject to tax. But remember, we have a progressive tax system, which means part of that's going to be taxed at a 10%, part of it's going to be taxed at a 12%, and then it's going to jump up to 22%. And even if all of that were taxed at the we're taxable at the 22%, it would still be 2% better, and you'd still have a 2% tax arbitrage versus what it was coming in. But I actually did this, and I ran that through the tax tables after taking a standard deduction, and the total tax on that $200,000 was about $27,176, and that meant that the effective tax rate was only about 13.5%. So for most people, putting that money into the traditional accounts is going to be the thing that's probably going to make the most sense for you. Now, the second thing we're going to want to take a look at is we're going to want to try to identify any asset shifting opportunities that we may have while we're still working. What do I mean by asset shifting? And again, I made another video about this a few weeks ago as well, where I talked more specifically about that. But assuming you've got some money in these different buckets, and in particular, if you've got money in those non-retirement accounts there, we want to see if there's any opportunity to basically shift money over into either a traditional or a Roth account and get a better tax advantage of that versus what it may be long term. So the way we do this is, the first way is we're going to want to make sure that we're fully maximizing all of our contributions. And before you jump in and say, well, Bill, I can't make any more contributions, I don't have enough cash flow to actually make that contribution, I'm right at the exact amount that I can contribute without really jeopardizing my level of spending that I need for right now, even while I'm still working here. But the point is that if you have money in this non-retirement account bucket, maybe it's $100,000, maybe it's $500,000 or a couple $1,000,000, whatever that may be, even if making those extra contributions lowers your cash flow to the point where it's actually negative, what you're going to do instead is you're going to actually take a withdrawal from those non-retirement account dollars and use that for some of your spending that you need for your cash flow. And you're going to be effectively, because you're going to be taking money from, let's say, your paycheck, and you're going to be putting that into either traditional or to Roth. And if you put it into traditional, that's going to be more money that's going to come off of that top level of income at that marginal tax break. Or if you're putting it into Roth, you're essentially moving money from an account that is taxed or can be taxed essentially on an annual basis to an account that's never taxed. So it's almost always going to make sense to try to shift money and get it from that non-retirement account bucket over to a Roth. So how can we do that? Well, there's some pretty nice catch-up contribution opportunities that you have probably inside your 401k plan. So for 2025, the 401k contribution is $23,500, and if you're 50 years old or older, that's going to be an extra $7,500. Next year for 2026, we already got the numbers, so that catch-up is going up by about $500 or so. So there's a little bit, and the contribution levels going up as well by $1,000. So next year in 2026, you could basically put up to $32,500 in that pre-tax contribution into your traditional 401k, 403b plan, whatever that may be. There's also something that just went into effect here in 2025, and if you're still working and you're 60, 61, 62, or 63, for those years, you can actually make what's called a super catch-up contribution to your 401k plan. And that's going to give you an opportunity to increase that catch-up from $7,500 to $11,250. So that would bring that number up to $34,750 here for 2025, and it's going to be a little bit higher again next year. And it's only for those 4 years. So if you're still working, that super catch-up. Now, one thing, again, there's all these tax rules that are coming out, it seems like almost on a daily basis, but as a part of, I believe it was the One Big Beautiful Bill, if you're in a high income situation, meaning that your income is greater than $145,000, then any catch-up, the regular catch-up as well as the super catch-up, those are going to have to be mandated to go to Roth. So if you're going to make those contributions, that's going to have to go into a Roth beginning next year in 2026. There also may be a way to get even more money into those traditional or Roth buckets through either the backdoor Roth IRA contribution strategy or the mega backdoor Roth IRA contribution strategy. So here's how that works. So let's say that you're over the income levels and you don't qualify to make a contribution directly to a Roth IRA account. What you can do to circumvent that is make a non-deductible contribution to a traditional IRA account. There are no income limits on that. And then you can immediately convert that money over to a Roth IRA account. So it's a way to get around that. One very important caveat on that, though, is if you have any existing IRA accounts, then this strategy is not going to work. It's not going to accomplish what you want because of something called the pro rata rules. So you may have no IRA accounts, and maybe you're able to do that. Maybe your spouse does have an existing IRA account and they may not be able to do it. So it is by an individual basis. So you may qualify, but your spouse may not, or vice versa, and that's something to look at. And that's something you can get some extra money into that Roth bucket. You can also, if your employer allows it, you can also do the mega backdoor Roth IRA strategy, and that's if your employer-sponsored plan, like your 401k, allows for after-tax contributions. So there was a tax ruling that came out, I think, in 2014 that now says those after-tax contributions inside your employer-sponsored plan can actually be directly rolled over either to a Roth 401k, or it can be rolled out of the plan into a Roth IRA account. And this is a way to get even more money and exceed those thresholds of those maximum contributions into your plan. So if you're under the age of 50, the maximum amount that you can contribute to your employer-sponsored plan is actually $70,000. So it's going to be $70,000 minus any regular contributions that you're making, minus any company match, and whatever that gap is, which could be as much as maybe $39,000, you could make those contributions into that after-tax bucket and then convert those over to a Roth. And if you're in one of those catch-up situations, you can actually do that as well, and you can put in that, and it could be as high as $81,250 in total contributions, because it's going to be all of your regular contributions plus any of your catch-up and even that super catch-up if you're qualifying for that. If there's any match, you're going to subtract that out, and again, that could be as well another $39,000 that you could effectively move over. And what we're really trying to do here, again, is we're saying, okay, even if, those are some big contributions if you're making those, but if you have money in this non-retirement account bucket, you can basically effectively asset shift those assets from that non-retirement account bucket to either traditional or to Roth by using that non-retirement account bucket to supplement your retirement or your current spending gaps that you may have as you're putting those bigger contributions into those accounts. So that's a great strategy, and it's a way to effectively, get more money into those more tax efficient vehicles for your retirement. The next strategy is to kind of pay attention to what assets are going into each one of these buckets. And something else I've talked about in other videos is you want to have, I think, a different investment strategy for each one of these three buckets here. Your Roth bucket is, again, likely going to be the last money that you're ever going to spend, and it has the best long-term tax advantages because as long as it's a qualified distribution, everything that comes out of the Roth is going to be completely tax-free. So what I mean by the asset location is you're going to have maybe more of your aggressive investments in that Roth bucket. And then if you want to balance it out and you want to have whatever that may be, a 60-40 or 70-30 assets or growth assets to conservative assets, you may have almost all of your growth assets in that Roth bucket, but you have your traditional bucket maybe invested more conservatively to basically get the right asset allocation for the amount of risk that you're comfortable in taking there. The next one is going to be the types of investments you put in these too, not just the category. And in particular, that's going to really apply to this non-retirement account bucket. So to understand how those assets are going to be taxed. Again, if you have any gains in those accounts on a yearly basis, or you have any dividends, or you have any interest, those are going to hit your 1099 forms, and you're going to be taxed in the year that you earn that money, whether you're retired or not. So as you're still working and you're trying to accumulate assets, what we want to do is we want to try to minimize the amount of taxes in that non-retirement account bucket. One way to do that is to basically try to buy investments that are going to be taxed at a tax preference rate. So we talked about the marginal tax brackets. Those are that 10, 12, 22, 24, 32% brackets. Well, for long-term capital gains and qualified dividends, those have a different tax table, and it's going to be a 0%, it's going to be a 12%, or I'm sorry, 15%, and it's going to be a 20% tax on the preference item rate. So if you focus on those types of investments that are going to get maybe long-term capital gains, things that you're not going to really turn over a lot, that's something that can give you some additional advantage there as well. And that kind of leads us to, again, those types of investments, things like ETFs, as an example, tend to be more long-term, and they don't tend to throw out a lot of those short or long-term capital gains. They tend to be basically where those can be tax deferred in a sense until you sell that particular investment. We can't say that ETFs are always going to have that situation where there's not going to be any dividends they're going to throw off from capital gains, but generally we find that that's the case, where those ETFs tend to be better long-term tax deferred vehicles, if you will. And then finally, the last one of this is going to be to look at that non-retirement account bucket and see if there's anything that you may be able to do some tax loss harvesting on. So if you have investments that are maybe down in value, if you sell those investments, you can basically reap the benefit of that additional tax deduction. Now, $3,000 of your loss can be used to offset ordinary income, and then those losses can carry forward indefinitely, even into retirement. But if you have gains in other parts of the portfolio, you may want to kind of balance that out. And so what you're doing is you're maybe kind of limiting, some of that buildup of that unrealized capital gain inside some of those buckets by selling some things that may be down, maybe even mid-year. Maybe some of those investments may be down in value a little bit. You may be able to take advantage of that and then sell something that's at a gain. You do have to watch out for that wash sale rule, which means you have to wait 31 days before you buy the same security back. But that's a strategy that you can do along the way to, basically not wake up one day in retirement and find out that you have this mega unrealized capital gain that you're going to have to pay taxes on as you go into retirement. So doing some tax loss harvesting along the way is the last strategy for that while you're still working. Okay, so now let's go into what does this look like as we go into retirement. And I'm going to be getting into the different phases of retirement like we talked about at the beginning here. But before we do, let's talk a little bit about how our retirement income is actually taxed. And I made another video about this a while ago as well. But we have basically three types of income that we could potentially have in retirement: ordinary income, tax preference income, and tax-free income. So our ordinary income is going to be those things that are going to be taxed at our marginal tax brackets. Those are those tax brackets we've been talking about: the 10% bracket, the 12, the 22, the 24, the 32% bracket. And it's going to include your Social Security benefits, but only up to 85%. And we're going to assume that everybody's going to pay taxes on 85% of their Social Security benefit. I know some people talk about how you can avoid that, but those limits were put into place in 1983, and they've never been adjusted for inflation. And I think probably most people watching this video could just expect and plan for that your Social Security benefits are going to be taxed. But right now, only up to 85% of those. If you have any pension income, that's going to be part of your ordinary income. Any distributions from those traditional retirement accounts like IRAs, 401k, if you have a deferred comp program that you participated in and that's being paid out in retirement, that would be included in there as well. Any interest income from CDs or bonds that's taxable interest, that's going to be part of that. Short-term capital gains, sales of investments that are at a gain that you've held for less than 12 months. And then if you have any other miscellaneous things like rental income, business income, that's all going to be part of that ordinary income, and you're going to be paying that at those tax brackets. Preference income is going to be two things primarily. It's going to be your long-term capital gains. So if you sell a stock or an investment that you've held for longer than 12 months, you're going to get that at a preference rate. And that's going to be either 0%, 15%, or 20%. And we'll talk a lot more about that here in a minute. And it's going to also include qualified dividends. So that's going to be primarily from stock investments. So if you have dividends from a stock portfolio, an individual stock, that's going to be a dividend. Sometimes that trips people up a little bit. They may have a bond fund that pays a dividend because that interest was earned as interest. It actually goes up on the ordinary income side. So that even though it looks like a dividend, it's actually treated like ordinary income there. But you have those preference items there. And then last, you have tax-free income, and there's going to be two primary sources for that. It's going to be your Roth distributions. If you take them as qualified distributions, that's going to be tax-free. And if you have any tax-free bonds like municipal bonds, those are going to be tax-free as well. But very important here is that all of this income, regardless of what category it falls in, is all going to go into something called your modified adjusted gross income. And that's going to be a key threshold that we're going to want to look at as it gets involved with some of the deductions and the IRMAA and the ACA subsidies and everything. So we're going to want to know what all of that income is going to be, and it includes all of this stuff, and it's before any deductions. So there's no standard deduction or itemized deductions or even charitable contributions or anything that goes into that. It's all going to be part of your modified adjusted gross income. So what are some of these key rates and thresholds that we want to be watching out for as we're putting together our retirement cash flow and withdrawal strategy, tax strategy as we're going into retirement? Well, I said it before, your Social Security benefits are going to be taxable up to 85%. Of those benefits are going to be subject to tax. That preference rate, the 0% bracket, like we talked about there, that's going to apply if your taxable income is under $48,350 if you're single, and for married filing joint, that's going to be $96,700. And if your taxable income is under those amounts, any long-term capital gain or qualified dividends is going to be taxed actually at a 0% tax rate. That's something very important there. There's a couple of deductions there. So when you get to be 65 years old or older, you get a deduction. It's going to be $2,000 if you're single. And then if you're married, filing a joint tax return, it's going to be $1,600 per person over age 65. So you could be over 65, but maybe your spouse isn't yet. You would get $1,600, but if both of you are over 65, you're going to get $3,200. And then as a part of the One Big Beautiful Bill Act that was passed on July 4th of this year, 2025, there's an additional senior bonus deduction. That's going to be $6,000 per person that's over age 65. That was in lieu of the no tax on Social Security. So we didn't get the no tax on Social Security. We got this instead. Not as good, but it's still something. So if both you and your spouse are over age 65 and you qualify for it, you could get a $12,000 deduction, which would reduce your income. There is a phase out, and again, this is going to also be tied to your modified adjusted gross income. So if you're single, your income, modified adjusted gross income, needs to be under $75,000, and if you're married filing joint, it's going to be $150,000. And then if you're over that, there's going to be a phase out. So I think you get a 6% reduction for every dollar that you're over those levels, and I believe it goes up to $175,000 for single and $250,000 if you're married filing joint, and that's going to be completely phased out. You won't qualify for that deduction. So ideally, these are all the things that we'd like to qualify for. We'd like to be able to get these deductions, and we'd like to be able to have this these opportunities, but we're going to have to manage that. We're going to have to figure out, does it make sense to try to really keep our income low enough to get that senior bonus deduction, for example? Does that make sense? Because it might mean that we're letting our IRAs or 401k plans grow too much, and that's going to be a tax problem for us later on. So these are the things we want to work on, some of the trade-offs here. Now, the last one on here is going to be the ACA subsidy, and that's going to be for those of you that may be retiring before Medicare kicks in, which is typically going to be at age 65 for most people. And a subsidy really can save a lot of money on those early retirement healthcare costs if you have to go out into the exchanges for that. There is a change coming next year in 2026. So essentially, as a part of the COVID stimulus that they put into effect, they made some really big enhancements to those subsidies. And whereas before it was cut off at 400% of the federal poverty level, and if you were over that, you didn't qualify for a subsidy. But during COVID, they extended those, and they said that the ACA premiums were going to be limited to 8.5% of your modified adjusted gross income. Those were set to expire at the end of 2025, and with the One Big Beautiful Bill Act, those were left to expire. They did not extend those subsidies. A lot of people have been talking about this, but essentially what that means is that if you're over those thresholds, even by $1, you will not get any subsidy for your health care going on to those exchanges there. They're fairly low, $62,600 for a single person, and if you're a married couple filing a joint tax return, it would be $84,600. But that's a big savings, and we're going to talk about this a little bit more. Again, it may be one of those trade-off things where getting a subsidy versus what are some of the other tax planning opportunities like Roth conversions and things like that. But basically, if you look at the numbers, a subsidy plan could cost a couple or a person about $5,300 according to the Kaiser Family Foundation, which is a good, well-respected source for all things healthcare related. But if you didn't get a subsidy, it would actually be $14,931. So we're talking about a difference of about $9,600 per person. So if you're a married couple and you can get a subsidy, that could save almost $20,000 a year in those early premiums that you're going to pay on the Affordable Care Act. So kind of a big deal, and it's a target that a lot of people are shooting for. But again, we're going to get into some of the details and see, is it actually possible for you to get that? And it's going to have to do with what other sources of income you might have coming in those early years in retirement, and how your money is kind of distributed between those three primary tax buckets. Another thing to keep in mind as you're going through early retirement is those IRMAA look-back thresholds are also going to come up at age 63. So if you don't know already, there could be some extra costs for your Medicare if you're over those certain thresholds. And again, that's going to be tied to your modified adjusted gross income. But it's always going to be a 2-year look-back, which means that 2 years before you turn 65 or at age 63, they're going to look at what your income was in that year you were 63. And if you're under 109,000 if you're single, or if you're under 218,000 if you're married filing a joint tax return, there would be no surcharge. You would just pay that flat rate for whatever Medicare is. And I think for Medicare Part B, I think this year it's about $175 a month. And if you go over that threshold, the next threshold up would be 109 to 137,000 single, or 218 to 274 if you're married filing a joint tax return. It would go up by another $81. And again, this schedule just keeps progressing, and those jump ups continue to get bigger and bigger as you get up, and it can even be 2 times or even 3 times or more what that base premium is to have you covered under the Medicare umbrella. Okay, so now let's start putting some of this together, and let's see what this looks like in the early part of our retirement as we walk through a little bit of a hypothetical situation. Now, a lot of this is really going to depend on how you have your assets divided between those 3 primary asset types, and if you have any embedded capital gains, for example, and what are the extents of that inside of your non-retirement account, and whether or not you have any sources of income coming in those early years. Maybe you retired and maybe you're getting a pension every month, or maybe you have some deferred comp that's getting paid out, or some other source of income that's going to be adding to your taxable income here. But whatever your situation is, I hope that you kind of get some of the ideas that we're talking about here, and maybe a little bit of the process behind what we're doing. And so our hypothetical client here that we're going to be looking at has about $4 million of investable assets, actually $4.2 million. And like a lot of our clients, the bulk of that money is going to be in that traditional retirement account, which we're going to assume has $3 million in there. And then they do have $1 million in that non-retirement account. And it doesn't mean that we should put more money into those non-retirement account assets. Again, like we were talking about while you're working, the idea, and I think the goal for most people is going to be to get money shifted out of that non-retirement account over into Roth or traditional. That's definitely going to work out better from a tax standpoint. But when we start looking at some of these scenarios, having some money in that non-retirement account definitely helps and definitely makes things a little bit easier. So we're going to assume they have $1 million in that account, and we're going to assume that $200,000 of that is just in cash or money market, and then $800,000 of that is in equity investments, a mutual fund or a stock or a combination of that, and their cost basis is $400,000. So they have $800,000 worth of asset and they have a cost basis. So if they sold it all, they would have to pay taxes on that $400,000. So what we really want to look at here, we're going to assume that this individual, let's say it's a couple, married couple, and we're assuming that they're 60 years old and they're doing this early retirement thing and they don't have any access to health care. So that's going to really be one of the first things that we're going to want to take a look at and see if it's possible for them to get an Affordable Care Act subsidy. So they have 5 years, obviously, from age 60 to 65 before they become Medicare eligible. We're also going to keep it really simple and say they're both the same age. In reality, they could have one of them be 60, one of them be 58. So we could have a 5-year window to go on those ACA subsidies for one of the spouses, and then maybe it's 7 years for the other spouse. That's where that more advanced financial planning tools like our eMoney financial planning software really comes in, because we can map all that out very specifically, because there's always going to be those individual situations there. So what we really want to do is we want to see, okay, if we want to get that ACA subsidy, we know we need to stay under about $84,500 of total income. That's modified adjusted gross income. So there's no standard deduction or itemized deduction. Nothing comes off of that modified adjusted gross income. So we're going to need to stay under that $84,000. So the goal here is to see how we can take money from those 3 retirement buckets and keep our income, if it's possible, under that $84,500. And one more thing that we're going to want to put in here is we're going to want to put in an amount of their required spending, or how much they need for their retirement. And again, everyone's going to be a little bit different here, but we're just going to say that's going to be $120,000 per year, or obviously that's $10,000 a month. So like I mentioned at the beginning of the video, that's really the most important thing as you're putting together your retirement, is putting together a plan that's going to get you the cash flow and the amount of money that you need to do the things you want to do in retirement. What we're getting into here is how to do this in the most tax efficient and the most optimized way. And there's a lot of opportunity to do that, but really getting that money is the most important thing. So what we really want to do is we want to do a couple of things here. We want to, number one, get that $120,000 out of some part of their portfolio, keep their income under that $84,500. And the third thing that I would like to do is I'd like to build up that cash reserve a little bit. Generally, our recommendation is to have at least 2 years of cash flow needs in something very liquid, very safe, like a money market, bank accounts and things like that. And then another 3 to 5 years of your cash flow needs in something that's going to be still very much on the safer side. Maybe it's a bond ladder, CD ladder, some sort, something still that's going to be much more on the conservative side, probably just not something that's going to be stock market related. So if the market has a crash, you're going to see that value go down. You want to build up a little bit of a buffer so that if or when the market does go through a downturn, you've got some reserves that you're not having to go out immediately and sell some of those equity investments and everything. So $120,000. So if we look at the places that we can get that from, of course, we could just take $120,000 from the cash bucket, and there's zero tax on that. There's, basically no tax at all on taking money out of your own bank account, for example. We also have the ability to take some money out of this $800,000 that has a $400,000 cost basis. Now, inside that $800,000 account, there may be different securities. Some of them may have bigger gains, some of them may have smaller gains, and there's really a lot of opportunity or ability to, I guess, go through there and cherry pick different securities out to really get that cost basis and the value dialed in so you can know exactly how much you're paying. But let's just say it's all pretty much 50-50. So in other words, if you take $100,000 out of that account, we're going to assume, to keep our math easy, that it's got a $50,000 cost basis, and that $50,000 would be added to your taxable income. So what I would say is we could take $80,000 worth of gains out of that portfolio. And if we take $80,000 worth of gains, it really would represent about $160,000 worth of stocks that we would be selling. So we would sell $160,000 worth of stock, and we would have 80,000 of it that would go onto our income, and specifically it would go into that modified adjusted gross income. And if that was the only income that was coming in, that $80,000 would not only be under the ACA subsidy level of that $84,500, but it would also, for a married couple filing a joint tax return, fall into that 0% long-term capital gain tax bracket. So that would be free and clear money for them to be able to take that money out. So we would take out the $120,000 for their spending need, and we would have $40,000 left over that essentially would go and get added back into that non-retirement account bucket. So if we continue to do this and we did it for the next 5 years, essentially what would be happening is they would be selling off $160,000 worth of stock. $80,000 of it would be considered a long-term capital gain. It's under the modified adjusted gross income level for qualifying for an ACA subsidy, and it's also falling into a 0% long-term capital gain tax bracket. So essentially, we have our $200,000 that was in that non-retirement account bucket to begin with, and again, we have that $40,000 left over every year, and so that's building up times 5 years, means that at the end of the 5-year period, we now have $400,000 in that non-retirement account bucket that's all in cash. We do still have a little bit of money over in the capital gain, and there's still a capital gain remaining of about $78,000 on the stock. And we've now gotten them to age 65 where they can now go on Medicare and start to not have to worry as much about having their income falling under a certain level that they needed to while they were qualifying for the ACA subsidies. Now, some of you may be watching this and you're saying, hey, Bill, that's all great and everything, but I don't have $1 million in my non-retirement account bucket. And does this still work for me, or can it still work for me? Well, we can calculate the exact amount that you would need to have in that non-retirement account bucket to be able to make this strategy work. So let's say you have most of your money in that traditional retirement account, and let's say you're going to want to target, again, we want to stay under that $84,000 ACA modified adjusted gross income subsidy limit. And if we took that $84,000 out of your traditional IRA account, and that's all the income that you had for the year, that would then qualify you for that ACA subsidy there. But we take $84,000 out, and we're going to have to pay some taxes on that. And in 2025, we get a standard deduction if we're talking about the married filing joint category. So that's $31,500. So $52,500 is our taxable income, and when we run that through the tax table, our tax on that money would be $5,836. So we need to subtract that from the $84,000, and we're going to net $78,164. But we're still a little bit short. And essentially, we're going to be doing this the same way every year for the next 5 years, including this year. So that $78,164, if we subtract that from the $120,000 that we need, we would come up with $41,836 that we would need in addition to that if we wanted to maintain that $120,000 spending amount. And if we're going to do that for 5 years, that would mean that we would have to have approximately $209,000 in a cash or money market or something that we don't have to pay taxes on, some money that we can access to do that. So it's not really as far-fetched and as hard as it may seem, as long as you don't have some big gigantic pension and you don't have a really high spending number. If you can keep that income low for these first few years of retirement, it's definitely achievable for you to be able to do this. If we took away that non-retirement account altogether, and this would be something that we would have to really map out inside the software, see what some of the long-term impacts are, but saving essentially almost $20,000 a year for our healthcare costs in those first 5 years, that's $100,000 that we're likely going to spend in those extra premiums on the ACA if we're not getting that subsidy. We said earlier we had a Roth account available to us. As long as that Roth is qualified and our distributions are qualified, it has to meet the 59.5 age test, and it also has to be incubated for 5 years. 5 years for the contributions, and then it's got to be 5 years from each conversion. as well, to be able to take the earnings out of that. So that could be a possibility for you to do that as well. A third option, as we're talking about this, and something we've worked out for a lot of our clients and scenarios, is to be able to skip the ACA program for the first year of retirement and just go on COBRA, which is a benefit that's available to everybody. So you can stay essentially on your company plan. It's going to be higher premiums because you're probably not going to get the company subsidy for that first year, but then it takes away all of the restrictions that you would have for the ACA, and you could basically do a large IRA distribution in that first year of retirement and then see if that amount, with some of the other monies that you may have available, could basically bridge you over to that age 65 when Medicare kicks in. And that may work a little bit better for some people that are maybe retiring at 62 or 63 and only need to create a bridge for maybe a couple of years of that. So there's a lot of options there, and that's one of the things that doing the comprehensive financial plan and getting into these details can really help us to do, and not only see what's possible in the short term, but also what that's doing to your long-term plan. So if you take your Roth money out and you use that for getting some coverage in the early part of retirement to skip those ACA premiums and keep those lower, well, then you're not going to have that $200,000 that's going to grow for the next few decades or whatever. So you're going to look at all of this in the context of your total financial plan. Now, if we go ahead and update our buckets after 5 years of taking that money out of that non-retirement account, and we're going to assume that we're back on the $1 million of assets in that non-retirement account, and we've been taking $160,000 worth of stock that has an $80,000 cost basis. So we've been taking out more than we need. So effectively, we've been building back up that non-retirement account bucket, and it's by about $40,000 a year. So that $200,000 that we had at the beginning is now worth about $400,000. And then if we apply some growth to our IRA account, traditional bucket, that hasn't been taking any distributions from that, we started off with $3 million. If we assume that you were to earn 3% per year, and then we're going to keep somewhat on target with inflation. I know it gets a little bit complicated here, but we're going to just say we're going to subtract 3% for inflation, and the account's really growing at 3% per year. So that would mean that the traditional account has $3,500,000 approximately in that, and we haven't touched our Roth bucket in this scenario, and so that $200,000 has now grown at that same 3% to $350,000. So we're getting an idea of what's happening here. Now we have 2 more years until we get to our full retirement age, and we're still planning out this early retirement. And this whole Medicare and pre-Medicare gets a little bit complicated here. But we're going to assume that now we have some money that we can access in those non-retirement accounts. That's all in cash. We do still have, I think, $78,000 in that stock or mutual fund portfolio, whatever that was. But we have $400,000 here, and we still need to take out about $120,000 per year. So that should be enough. But what do we want to do here now that we have freed up that restriction on the Affordable Care Act? Well, now we can come along and say, maybe we should be looking at doing some Roth conversions so we can start to transition some of our portfolio from that traditional bucket over to Roth so we can avoid higher taxes later. And we want to do that on our terms, not on the IRS's terms when those RMDs kick in at age 73 or age 75. So if we look at the tax table and we see that for 2025, the tax table for the married filing joint goes up to $211,000 in that 22% tax bracket. So $211,400 is the amount of taxable income we can have and still be at that 22%. Now, it doesn't mean that all of that money is going to be taxed at 22% because some of it's going to be taxed at 10 and some of it's going to be taxed at 12, and only that amount that's over that number, about $96,000, is going to be taxed actually at that 22% tax bracket there. So when we do that, we can basically take this $211. We know we're going to get that standard deduction of $31,500. So we can have actually $242,000 worth of a withdrawal from that traditional retirement account and still be in that 22% tax bracket. Here, we don't have to be quite as careful about going over. If we go over by $5, it's only going to be on that extra $5 that we were over the limit that would hit that next tax bracket, which would be the 24% tax bracket. So it's not a cliff like it is on the ACA subsidy or on the IRMAA penalties and things like that. So when we run that through that $242,000 through the tax bracket, it comes out to be $36,725 is our total amount of tax, and that represents an effective tax rate of 15%. But here's the thing, that $211,000, that's going to be right at that IRMAA level. When we add in the extra amount for the standard deduction, because again, modified adjusted gross income is before all of those deductions, we're actually going to hit the first level of IRMAA there, which is going to be an extra $81 per month per person. So when we add all of that up together, 81,000 times 2 times 12 is an extra $1,944. But even when we add that to the 36,000, our effective tax rate just jumps up a little bit, goes from 15% to 15.9%. So again, depending on how much money you have in all of the different buckets, maybe it makes sense to try to say, hey, we don't want to maybe do that much of a Roth conversion. We want to basically keep under that IRMAA penalty. We don't want to pay that extra $2,000 a year. I think in most situations it makes sense to not go super high on the IRMAA, but going up to that first level of IRMAA to pay an extra couple $1,000 to be able to convert an extra $31,000, $32,000 over from traditional to Roth. I think that's a pretty good deal. And so, but again, that's where the software comes in, where you can really kind of map it in and see exactly what that's doing and what that difference is. But that's a pretty good opportunity. So over the next couple of years, if we say these next 2 years from age 65 and 66, before 67, that's when we're likely going to start collecting our Social Security benefit. That's going to be almost $500,000 that we're going to be able to chunk over from that traditional account over to the Roth. So now let's update our tax buckets again after doing this for 2 more years from age 65 to age 67. So we started off with $3,500,000 in our traditional bucket, but we've been taking out $242,000 every year, and we've been adding that over to our Roth bucket. And our Roth bucket started with $350,000, and we're adding $242,000 to that bucket every year. So we're subtracting a little bit here. We're still going to assume that we're getting that same 3% after inflation growth, and that's going to be $3,221,000 is going to be the balance of that traditional bucket. Our Roth bucket is growing, and now we have $862,575 in that, again, assuming that same 3% rate of growth. We started off after we did our first 5 years optimizing for the Affordable Care Act. We've been taking out $120,000 for our living expenses, plus we also had to take out about $37,000 for our taxes on these Roth conversions from that bucket. And generally, that's going to be the most optimal way to pay the taxes on those Roth conversions. It does make sense if you don't have any other ability to pay the taxes from one of these non-retirement accounts. You can take it out from the IRA. It would just mean that you would convert a little bit less and take a little bit more of a distribution from that IRA account to be able to cover the taxes on that. So at the end of that, then this is basically, after 2 years, we are down to about $88,000, I think is the number here in that cash bucket. And we can see just in working this out, I know this math gets a little bit involved in everything, but we can see what that strategy looks like, how we can keep our income low in those early years of retirement, potentially get an Affordable Care Act subsidy, saving $20,000 a year, or in this case, $100,000 over 5 years, and then still have a pretty good opportunity to start shrinking down that traditional IRA account and really building up our tax-free asset by a pretty substantial amount, 4 times as much in that Roth bucket from where we started this whole scenario 7 years ago with that $200,000 in there. And what we're also going to want to do is we're going to want to be thinking about what is that next phase going to look like. So if we continue this scenario, we're going to assume, and that's why I took inflation out of some of these numbers here, so we can still say that in today's dollars, we're still targeting that $120,000 per year, but you're going to have some Social Security benefits in here. We'll keep this math pretty easy and we're just going to say your Social Security benefits are going to be about $60,000. So if you're looking at your Social Security statement, you might see, okay, I've got $60,000 today in 2025, but this is going to be fast forwarding 7 years into the future, 7 years, 2032. That's why if we keep that inflation backed out of this and just show the net real growth is what that's called in economic terms. So real growth is after inflation. We're going to have basically $60,000 is going to be our required withdrawal from that portfolio. And what we also want to figure out here is, what does this next period look like as we go into that next phase of our retirement, which is the full retirement phase. So we still are going to need $120,000 per year, and I've tried to keep this relatively simple rather than trying to figure out how much things are going to cost in 7 years or 10 years or 17 years. We basically, in doing some of the math, we backed out the rate of inflation from our growth rates of the portfolio, and this is the reason we did this. So if you're looking at, for example, your Social Security statement here in 2025, and it says I'm going to get, combined with my spouse, $60,000 a year at my full retirement age, well, that number is going to go up with the cost of living adjustments that Social Security kick in. So if we did that and we assume that your Social Security benefits for you and your spouse in this scenario here are $60,000 at that full retirement age, we can keep all of our numbers in today's dollars, and just basically we're going to subtract that $60,000 from our 120. So at this point, we're going to need $60,000 going forward to take out of the portfolio, and that's going to be something we're going to want to think about as we're building out those cash flow buckets. Again, keeping a couple of years of cash flow very liquid in a money market, bank accounts, and then maybe that middle bucket, which is going to be maybe a bond ladder, CD ladder, or other types of fixed income, something that's not going to be tied to the market that could go down when the market goes down. So that's going to be our number there. And if we basically say $60,000 for the next 5 years, then we should basically probably in that traditional retirement account have about $300,000 saved up in just a liquid, safer type of a portfolio, so we can basically have that money available to us as we start to take those withdrawals. Okay, so now we're at your full retirement age, and things are going to get a lot more normalized. We're going to have that $60,000 coming in for Social Security, and you're still going to need to take $60,000 out of the portfolio every year. We're starting with about $88,000 in that cash bucket, $3.2 million in the traditional IRA, and $862,575 in the Roth account. And we're going to assume that things are going to just continue to go on the way they are for the next 8 years until you reach age 75, which is going to be your required minimum distribution age. So we're going to do a little calculation here. So again, we're targeting that 22% tax bracket, which is about $211,000. We're going to add in our standard deduction, $31,500 for the year, and that means we can have $242,000 of total income and still be in that 22% tax bracket. It is, again, going to push us up into a little bit of an IRMAA situation there. So we already calculated the tax on this earlier, and it's going to, as we run it through the tax table, mean that we're going to make this math a little bit easier, rounding off a little bit, $40,000 in tax plus that IRMAA that we're going to have to pay, which is about another $2,000. So that's going to basically give us about $202,000. Now, we need to have about $120,000 to live on. $60,000 is going to come from Social Security, so we're going to have to basically subtract that tax and also subtract the living expenses from that, and that's going to be $142,000 is going to be left over for Roth conversions. And we've already calculated the tax, so we know that the tax is being covered by that entire $242,000, and we're going to take that tax out as a distribution from the IRA account to cover the taxes on that Roth conversion. So now, as we look at it, and we look at what our buckets are, we're going to basically have $242,000 that's going to be coming out of the traditional IRA, and we're going to have our Roth, which is going to have $142,000 going into the Roth IRA. And the difference of that, why those numbers don't exactly match up there, is because the rest of it is going to be used to cover our taxes and our living expenses there. So if we redraw our buckets here now, we have $88,000. We just kind of left that alone and said that's maybe just a cash buffer just to keep our numbers easy there. So our $3,221,000 minus that $241,000 per year for 8 years, and assuming that we still get that same real rate of return after inflation of 3%, that's going to go to $1,928,000. So we're actually taking money out of this, and we're actually taking more money than that account is making. But again, we're reducing what our future required minimum distributions are going to be at age 75. Here's where this gets really good. That $142,000, we started with $862 in the Roth IRA account at the full retirement age 67, adding $142,000 per year and getting that 3% growth now brings our Roth IRA account up to $2,355,395. So I hope you're starting to really see just how powerful having this tax strategy mapped out, how it really can work. And again, you can't have the tax strategy without also incorporating the withdrawal strategy too, because I see a lot of these videos too, and you're probably watching a lot of those videos, and it's basically saying, okay, here's how you calculate your Roth conversion. Well, you got to live on something. Where's that money coming from? How are you paying the taxes on those Roth conversions? And we're doing this by hand, kind of old school way, but again, the software that we use to do this really does all of this for us. So we map out the cash flow, money coming in, money going out, identify our gaps. Some of those years are going to be different. You may say, I'm going to take a big trip next year, and that's going to be a $50,000 withdrawal. That's going to be a different amount that you're going to have available potentially for doing the Roth conversion, or it's going to push you up into a higher tax bracket. All those things need to really be looked at here. And now what we want to do as our last step is we're going to go ahead and we're going to see if this required minimum distribution is actually going to be a potential problem for us, and we'll get into that. So now we're going to see if this RMD situation is going to be a problem for them. So at age 75, if they have $1,928,321, if we look it up, the RMD table has a divisor, and we're going to essentially divide our previous December 31st IRA account balances. We're going to add them all up if you have multiple accounts, and we're going to divide that by 24.6, which is about 4.07% of the balance that we have is going to be what that RMD is going to be. And when we calculate that, we know that the RMD is actually going to be about $78,387. So again, compared to where the tax tables are, trying to still target maybe that 22% tax bracket, that's probably not going to be too much of an issue here. But let's take a look. Let's run through our math again. We're still targeting that same $211,000. We have our standard deduction that we can take, $31,500. Our total tax, as we've been saying here, for the running it through the tax tables, and then also including in that extra IRMAA, assuming we're still paying that. And then we also have to subtract our living expenses. And the living expenses, even though this is like 15 years down the road, we are still going to leave those living expenses the same because, again, we backed out the inflation from all of the other numbers. We backed it out of Social Security. We left that at the same level. We also reduced our growth in our portfolios from that 6% down to 3% there. So, and that's going to give us the same ability, exact ability to do those same $142,000 Roth conversions. So we can continue to chip away at this, moving money from traditional to Roth. In fact, what we would probably do in our software is we would maybe go back and back that up and say, hey, maybe we don't have to do as aggressive of a Roth conversion each year. Let's take out maybe $30,000 of those Roth conversions and keep ourselves in that first level of IRMAA without having an IRMAA penalty at all. And that would save a couple $1,000s a year. Or we get to age 75 and we can see where the growth of the portfolio has gone. And then we can say, hey, maybe we don't have to be quite as aggressive. But there's a lot of reasons to doing these Roth conversions. One, we're assuming the tax tables are going to stay exactly the same. Now, the One Big Beautiful Bill Act did effectively keep the tax rates permanent or make the tax rates permanent, but permanent only means until a new Congress or a new administration comes in and does something different with the taxes. And They could potentially raise the taxes in the future. They could also potentially lower the taxes in the future as well. Probably don't think that's going to happen, but it could happen. We've also heard other administrations in the past recently talking about raising taxes on people that have incomes over $400,000. I think that's something still to kind of keep in mind there, that it could be an increase in taxes if you're at one of these higher brackets. So if we redid this whole scenario and we said you started off with a $6 million traditional IRA account, that might mean we're going to have to get a little bit more aggressive. We'd probably have to go into that 24% bracket, and we'd still have some IRMAA to contend with as well there, probably going into the second or maybe even the third tier of IRMAA, and that could be some additional cost. But again, we want to bring those IRA balances down so that this is not going to be a problem for us when that required minimum distribution kicks in. The other thing we want to think about too, especially if we're talking obviously about a married couple here, we're assuming this is the married filing joint tax table. And you might have an IRA in a 401k, and your spouse might have an IRA in a 401k. But that's all going to be, collectively looked at, each based on your own individual age. But if something happens to one of you passes, likely what is going to happen is your IRA account is going to transfer to your spouse, and they're going to have that money all in their IRA. But the big change is going to be that they're no longer going to be able to file taxes on the married filing joint tax table. They're going to be on the single tax table, and we can pretty much cut all of those numbers in half. So when we're looking at $211,000 is the top of the 22% tax bracket, it's going to be about $105,000 that's going to be the top of the 25 or the 22% tax bracket if we're talking about a single tax filer there. So that's something to really think about there. And really kind of getting ahead of this. And again, we're kind of mapping this out, and we do the same thing in our software too. We have to put some assumptions in there. If your growth rate is higher than what we anticipated, that's going to be a bigger reason to do some of these Roth conversions. And we want to be thinking about that. The other thing is that we basically are assuming that the accounts are growing at the same values. But as I kind of mentioned earlier, as we were talking about asset location, and we're looking at those different buckets and everything, the Roth bucket should theoretically be invested more aggressively than the traditional bucket. And so that may be growing at a 4% real rate of return, and maybe the traditional bucket is growing at a 2% or 2.5% real rate of return on that. And that's going to slow down the growth in our traditional, and it's going to accelerate the Roth. And so ultimately, having tax-free money, I think, is a great thing. And having a strategy to get money from traditional to Roth and planning that out within the context of your retirement withdrawal strategies is basically what we're trying to do here today. So if you stuck around all the way to the end of the video, I really appreciate it. I've got papers all over my desk. This is something I do almost every day in my practice, working this out, but we do it all on computers and software that's very, very high-end software. And so to really kind of get behind the scenes and really kind of do the math, really I had to kind of think through a lot of this. And I hope I explained it in a way that's going to be something you can kind of resonate with and maybe see some of the logic, because I think sometimes computers are great, but when you just see the number, and I could illustrate this whole scenario in 5 minutes inside of our software, put it in, plug in some Roth conversions, the withdrawal rates are all being calculated, the taxes are all being calculated for us, and we can see what all those different things do to your long-term, short-term, to your cash flow, to the tax situation down the road. But kind of seeing the math behind it, I hope has been helpful to you. So anyway, I'm Bill Leatherman, moneyevolution.com. Hit that like or subscribe button if you haven't already. And if you'd like to learn more about the financial planning that we do, go down to the description below. We've got some links down there. We call it the Retirement Time Machine, and it's a great program for anybody that's getting more serious about planning for the retirement and is really trying to juggle all of these different moving pieces of your retirement and really figuring out how everything kind of pieces together there. So anyway, thanks for sticking with me, and I'll see you back in one of my next videos. Thanks.